Hello, my name is Lee McFarland from Kinship Investments, and I can't believe I'm making this video for the third time. I am just starting a webinar series. This is the first, and I'm trying to do a weekly series at the end of trading on Friday afternoon, which for myself it reviews the week that I had, what decisions I made, what the markets were doing, and also go into a bit of how I do trade. I won't give all my secrets away, but I am an options trader as well as futures, so derivatives. And I have a business in this sense, so I am a professional trader. In Canada, I am what's called a certified market derivative strategist, and I do this mostly for a living. I do have residual income from other sources, but this is primarily what I do. My series of videos, we're also going to review a couple they're going to hit on a couple things, and the main things are that I'm doing this because as a business it is very difficult in Canada and in the US of course too, but I want to discuss how that works, and thirdly looking to make it interesting for people such as myself, and hopefully I gain some interest from traders and investors alike, because at the moment, you know, the way that we succeed is to have more capital, and I don't have enough capital to make a living. So I'm working with local people in my area in Canada to help raise money, but it's difficult, and hopefully this kind of attention, if there is any from a webinar, will help with that. So briefly, I just want to make this a quick introduction, and I made a couple of test videos before, and I found that I am able to really blabber on. So I'll try and be concise. I do about 5 to 10% a month on my revenue, and as an option seller, which I do, I sell credit. So I sell naked options, usually iron condors, and this isn't new to people who do options. But I work strictly with options on futures. I find that I'm able to acquire more credit with better risk. So for me, that works well. The only issue with working with options on futures is the liquidity. And the liquidity of the market is fairly narrow. It's not as good as the QQQs, the SPYs, you know, the Microsoft, you know, any stocks or ETFs or index funds, those sort of things. You know, nowadays in the SPYs you have weekly, monthlies, QQQs, same sort of thing. But in natural gas and crude oils, what I primarily work with, it's just monthly. At least it is monthly at this time, and it has been for a while. So I'm able to make a good amount of credit or income from selling iron condors. So it simply means that if you have a price of, and eventually I'll show more of what I utilize as a system, but let's say at this point crude oil is at $50.38. It's Monday, getting into the evening trading session. I'll go far out of the market on the calls and the puts, sell those, and then buy ones that are just a little bit even further than those. So if you can imagine, here's the price, here's the price, and I'm on either side of it selling calls and puts, and then buying a little more outside of those, the calls and puts. So what that does is it mitigates your risk, so your margin is contained from your brokers, and I go far enough out so that I have a lot of time to adjust. So whatever credit that you get, you have some sort of plan to adjust. So if that price starts moving one way or the other substantially, your let's say there's a call side, will increase in price, and that means you're losing money. So what do you do to mitigate that, right? And even though you might be still way far away from your actual call itself and the price of that call, you still want to attend to that that difference in price from when you initially attained the credit, because eventually you may get to the point where you want to get out. So if you're able to have a system in place that is able to capitalize on that movement and adjust, and then if it gets to a point where it's too much and you do another adjustment and close of that, you get out at a very small loss or break even or something like that, and no harm done. You might not make that 10% for the month, but hey, you might make 2%, and that's pretty darn good. So I see I'm already talking here now 6.5 minutes, so I'll describe to you briefly what else we do. Is we've been looking at marketing our future system. We have 7 years of forward tested history. So for 7 years, week after week, day after day, I've been tracking what our system does, and we have, when I compare what we do to other people, we have a really good thing going. But in Canada, the problem has just been, it's just difficult to market. I thought when I started doing this sort of thing, we have 11% return for 7 years on the average, with a 2.4% deviation from that. That is very, very, very good. And our margin, our difference from real price of actual real money to our hypothetical tracking it every day is very small, very, very small. So I thought at the time that people would just be rushing out to throw money at me, but it doesn't work that way. You really have to, I'd say, pay your dues, and I found a lot of issues with where I am in Canada with low, you just cannot. It's just so difficult to run a business as a hedge fund, because if you're doing trading and you're taking money from any investor outside of yourself, you're categorized as a hedge fund. I know there's different categories in there, but it's basically hedge fund in Canada, okay? And to get registered in Canada, it takes about 1.2 to about $2 million cost, and that's gone cost, and I don't have that money. I don't have that money. So it's been interesting. I am one of the first people in Canada to work out an exempt market product where I am in BC, British Columbia, Canada, legally. I work with lawyers to create a legal instrument, a legal platform, so that I am able to retain funds from investors and be able to do what we do. Basically, we're saying we're testing a system, right? We're not managing a fund. We're testing a system, and investors are benefiting from that. That's it. That's all we're doing. That's how you have to. That's how you have to label yourself, because otherwise, you're a hedge fund. You have to be registered. You have to pay the fees. You have to do this and that. You have to pay $60,000 plus a year for accounting and administration and blah 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 blah. In the States, I just came back from Chicago, okay, and people in Chicago, I was talking to people who know their stuff, okay. I was having drinks in the back of the CME, right, with traders, with allocators, with people who know what they're doing. They had no idea it costs as much in Canada as it does. Down there, if you want to open a CTA shop, $3,000. So there's a little divide, okay? And what I'm saying is that eventually, if I'm absolutely at any time able to in the future to influence what we do in Canada is to fix the system. Okay, I'm a trader, I make money, that's it. And if I'm independent, I'm done for. I am done for, because IIROC is controlled by the bigger banks. They make the rules and they tighten those leashes, and it's very difficult. Luckily, if you had a hedge fund, you started 15 years ago, 20 years ago in Canada, you're now grandfathered in all this. But now they're paying all the extra fees and costs every year and every year. It's very difficult. There's so much to talk about when it comes to the business of running a fund as an independent person, trading, management, your platform, your psychology, your this, your that, blah, 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 blah. I hopefully every week I'll touch a little bit on that. And this initial video is just something to show that if you really want to know the beginning of what I'm doing, watch this. Otherwise, don't worry about it. On Fridays, I'm going to put something out there that that will review the week, discuss what I'm looking at. So we'll see how it goes, and I appreciate you watching, and see ya.